first rates then on your screens right now, 0.5% higher for the Nifty, 21,750 plus levels. And there you go. It's all about IT really this morning. Infosys gapped up 4.5%, 1560 on that stock right now. HCL Technologies 2% higher. I want to see what TCS is up to, nearing that 3% gain mark as well in trade today. So a very positive move, much along expected lines, all charge led by IT this morning. Wipro as well seeing a very smart move, as is HCL Technologies, like I mentioned. In fact, the entire sector is above buzz. LTIM, Tech Mahindra, they're all holding up very smartly in trade as we speak right now. Where is Reliance Industries, considering really that's been the core for the index the last two trading sessions? Today it's a little tempered, 0.5% lower. But you know what, for Reliance, the move typically has been happening in the last half an hour of trade. So don't go by what Reliance opens at. The stock has been in a habit of chugging along and pulling up in the last lap of trading sessions. Okay, there's Concord. The total Q3 volumes have seen an uptick of about 6%. The EXIM volumes as well are higher by about 8.25% for the quarter. Tata Power, after that MOU that they've signed for renewable energy, look out for what that stock as well does. 6.5% higher. A large block deal nearing 1% on Nykaa as well, which has happened. And there were rumors during the rounds that Lexdale International may be selling a quantum of 2.6 crore shares, equating to about 490 crore rupees in Nykaa. That stock lower by about 1% as we speak right now. Bunch of other stocks which are also in focus, and I want to revisit what Polycab, KEI, you know, all that entire wire and cable space as well is up to. Let's see what Polycab is doing, considering you know, it was all the news around this stock yesterday. Today it's seeing a bit of a relief come in, 3.5% higher for Polycab. KEI as well, 0.6% move coming in on this particular stock. And RR Kabil should be the other one which should come up for you on your screens. That stock, considering that also has been beaten down, 1% of a move coming in on this particular stock as well. Almost a 0.5% uptick is what we're sitting on for both the Nifty and the Sensex, and quite a decent day actually for the broader markets too, led of course by what IT has been doing.
Absolutely, that's what IT has been doing, as well as, you know, some of these other names that are interestingly coming in from the mid and small cap space as well, and that's holding on to very strong gains as well. Whether you look at something like the new listings, RBZ Jewelers, Moti Sons Jewelers, all of them are continuing to see good gains there as well. And let's see Senco also, because that was holding on to good gains there. Bajal Products, that's a spin-off of Bajaj Electricals, that has also been in focus today on the back of an order win that they have as well. So Bajal Products is what we're keeping an eye out on. It's a new spin-off company and which is listed on the exchanges as well. So yes, that's there. And IT obviously holding on quite strong, whether mid-cap IT, large-cap IT. Tata Consumers, that's holding on to some gains over there as well. Strong gains on that front as well. 2% uptick as of now there. Other than that, look at some of these other names like Havells, that's holding on to very strong gains. Trent, as well as Oracle which is holding on to very good gains in this morning trade as well. But Kunal, your first trades this morning?
Well, that will be Voltas, and you know, a stock which you've been discussing earlier after yesterday's move, specifically about the 1,000 levels. I think it makes a lot of sense to hold on to the stock, especially looking at yesterday's breakout, expecting at least another 50-point up move for the stock over the very near term.
Okay, there you have it. Voltas, day after day, that's the stock that Kunal is flagging off as one of his top trading recommendations. Kunal, I just want to get in a quick chart check. Perhaps, you know, Infosys is a stock that we'll talk about, as well as TCS. Of course, IT is hogging the limelight today, rightly so. But what are you making of the trends? Was this move expected?
Yeah, so I think we were discussing this yesterday, you know, with Nikunj, that, you know, the IT pack could probably open with a strong kind of a, you know, move. And I think Infosys, what we expected was a 5% either up move or down move. Now, luckily, the stock has opened up with a strong uptick, but I believe that this could be a start of a strong breakout move for Infosys. So, wouldn't be surprised that the stock over the next you know, couple of weeks gains up another at least you know, 50 to 100 odd points from current levels. That could be a good 6-7% rally for Infi. And for TCS also, I'm expecting the stock to head back towards the 4,000 plus mark.
Okay, all guns blazing for IT, and let's pick up on that discussion. We've got Vikas Khemani joining in from Carnelian Capital. Vikas, hi, morning. Surprised by what TCS and Infosys have managed to do? Just so beaten down in terms of sentiment, and even an inline set of numbers or a slight beat is what the street gets impressed with.
I mean, you know that. I mean, we've been quite positive on the IT sector for quite some time, and we have never been perturbed by quarter on quarter. As long as we believe that there's a long-term trend which is in favor, and I've said in our past interactions as well that we are positive on IT, and I think the execution cycle will only pick up. And I've again said that IT is the best trade on interest rates coming down in US. The developmental spend will come, and as the execution accelerates of the order book, growth will come, and that you will see, in quarters to come, only getting better.
Okay, fair enough. Vikas, let's get in your sense then overall in terms of the fact that it is an election year. We have as well last year had pretty much all of the pieces that were put into place when it comes to the overall macros, the earnings season. How is it that you're expecting the year to pan out, in particular with the CapEx related theme being in the spotlight on the back of elections?
I think, I really don't think, elections are as important. I think the CapEx cycle has been on upswing for quite some time, last couple of years, and we've been betting on that. Of course, both private and public CapEx is fighting, and that I think is likely to continue before election, after elections. So I think it's a multi-year theme. India is being rebuilt, India's capacities are being built, and whenever such kind of uptick happens, you see a multi-year cycle. So I don't think election is a very big play in this. And fortunately, this government does not also spends only around the elections. They have been spending right through last couple of 3-4 years specifically. So I think it's a multi-year trade, multi-year investment cycle.
Right, Vikas. I'm just looking at some of your holdings, and Senco Gold, that's popping up there because we've seen these jewelers actually doing quite well in trade. Whether you look at, the new listed companies like RBZ, Moti Sons, even a Kalyan in terms of its Q3 update has been quite good. Do you see more value there in these jewelry retailers? Would you look at that bunch even more and closely now?
We've been invested in the company, and we see it's a fantastic company. It's when we bought, when it was, I think, very, very underpriced, around 20 to price earning ratio around the IPO when there were not many takers, and we've been holding since then. So we really don't necessarily take a lot of view on. I mean, it's not an industry view; it's probably view on the company, and of course, discretionary consumer spending is picking up. I mean, we have not bought many consumer stocks in the last 4 or 5 years. But whenever we find an interesting, credible story available at a reasonable price, we would definitely buy. So this is one of those things.
Right. Vikas, can't help but talk about the new theme which has emerged, or not new actually, but the dominant theme which has emerged on the sidelines of the Vibrant Gujarat Summit as well. And, almost a unichorus for renewable energy. How is it that an investor can best capitalize on this theme now?
I think renewable energy as a theme has been around for quite some time. India has been building capacity. India has already kind of achieved its targets 3-4 years ahead, and it's only getting better. The only thing is, I think there are not many investable plays in the listed space on that, but we have played the power sector through the thermal power, because we think that India is staring at a shortage of power. New capacities have come about, and so in India, I think. So over the next 4 or 5 years, we will have to build thermal capacity, and that is where we have played on that segment.
Okay, fair enough. There's also, Vikas, the view that, one should be looking at a bit of a defensive tilt, pharma making a comeback, while yes, within FMCG, there could be a bit of a slowdown. But how exactly would you advise investors to position themselves within the entire defensives basket?
So again, we don't buy pharma because it is defensive. We bought pharma because I think it is growing. Pharma was, not going anywhere in last 7-8 years, except last 1 year or so. And we think that the 7-year cycle was over, and we are beginning to see a very interesting trend developing in the segment, both from a US market perspective as well as the domestic market perspective. US markets are getting better. And expected to get even more better. So we think that that underperformance of 7-8 years will catch up. So we are not buying because it is defensive. We are buying because it can grow, and that's where I think big money can be made.
Right. Because in pharma also, would you look at the large cap pharma or mid cap pharma? A lot of names that you would look at in that space as well right now, and any specific name you are considering?
So, I mean, frankly speaking, there is opportunity all across. You got to really look at business model. I mean, pharma is a very wide name, but each pharma company is a very different business model, different focus. So you have to really, see individual company very differently. You really can't broad brush decide on that. So it's really bottom up, and there is a value, there is opportunity across the spectrum, large cap and small cap. And mid cap. So, but it depends. We like CDMO space. We like domestic pharma. We like companies which have been exposed to US markets and have a dominant positions there and now beginning to get. We like companies which have specific new products coming and beginning to fire. So it's really not, you really can't have one approach to in pharma. Each company is kind of very unique in that sense.
Okay, fair enough. I just wonder what the outlook is from you when it comes to the overall FIIs, because while we could characterize the year gone by as maybe FIIs remaining sellers, sitting on the fence, do you think that this year FIIs will make a comeback in a big way? And if not, would that be a concern?
I have no doubt on that. There will be very big money coming into Indian markets. We have spoken about in the past. FI flows is very directly linked to the interest rates going up and down in US. We saw a lot of outflow when the interest rates were going up. Last year we said interest rates peaked out, and hence, you will not see outflow. But for inflow to come, interest rates will have to come down. And we already have sort of indication that, from Fed that 2 or 3 rates would cut might happen in calendar 24. That itself sets the pace for or the direction for FI flows to come. And secondly, I have a fundamental belief that India is one of the most promising market in the world. And today also India is significantly underrepresented in global portfolios. So both these trends would get corrected as this cycle turns, the tide turns. So I do believe that in next couple of years, including calendar 24, we will continue to see massive flow coming from FIIs.
Vikas, just looking at two individual names, and you can surely, skip to comment if you wish. HDFC Bank and off late even ICICI Bank. I mean, HDFC Bank has been one of the stark underperformers and one of the most disappointing stories. Hasn't really seen the light of the day, and off late even ICICI Bank has gone into some bit of a limbo. What explains the underperformance from private banking as a lot? And I'm going to miss out on a few large exceptions here, sporadic moves by an Axis or IndusInd, at a time when end of last year everyone's consensus call was that FIIs are going to come back, money is going to flow into private banks at large are going to be the best rate for 2024.
I think we have taken slightly different approach. We've of course played ICICI Bank in last 4 years. It has become almost 3.5, 4x for us. We've been very big believer on that story. We never bought HDFC Bank because we believe that HDFC Bank might get derated. And it's a fantastic bank. There's no question on that. Of course, but it's going through its own transitionary period. So might see some more underperformance continuing. But in general, I think somewhere middle of last year, we pivoted towards PSU banks because we think there's a big transformation happening. And as a result of that, we believe that PSU bank as a basket would outperform the private sector bank. And it is very natural for something like ICICI Bank, which has become 4x and everybody owns it. So to consolidate for a period of time. But I have no doubt that banking as a segment will do well because there's no way India can get built or India can grow without growth in the credit and large private sector banks. So I think the entire banking basket would do that well. But I think from a medium-term perspective, probably PSU banks might deliver better returns.
Right, Vikas. There's one sector and one specific part of the sector, that's the two-wheeler space, that's been holding on to very good gains as well for the Bajaj Auto, TVS Motors, Hero Moto. Do you think that is something one should look at in terms of overall? Do you find more value in two-wheelers versus four-wheelers?
I think my entire auto basket, if there's a growth coming in the entire basket, and and we've been significantly overweight in the auto space. We own M&M, we own Tata Motors, so we used to own Bajaj. I think in one fund we own Bajaj Auto as well. So I think we like the entire basket in that sense because it again cannot happen that infrastructure is getting built, roads are getting built, consumption is getting increased, and auto not do well. So it has to do well, and I think that story will continue, and at least in next couple of years. And we'll have to keep revisiting, but we are right now positive.
Right, interesting. Vikas, the other thing, of course, is, at large, because the mid and small caps have run up the way that they have, and a lot of pockets there are getting frothy. Now, I know you have to get into case-by-case scenario over here, but would it make sense to tactically have a larger allocation to large caps at this juncture?
Really depends what kind of investors you are, what your time horizon is, can you really make those changes? But yes, there are some large cap pockets where there's a value, and if the FI flow comes in, large caps will lead the way. That's a very, very par for the course natural phenomena. So in that sense, you might not see this kind of underperformance which you saw in 23 in large caps. And of course, no doubt that there are pockets where there's a froth in mid and small cap. So to that extent, it might get corrected. But the way we look at it is that when you buy in small and mid cap, you buy them for many years. You don't trade in, trade out. So our approach has been buy good quality companies, good in the middle of mega themes or good themes, run by great management, and sit on them for 5-10 years as long as the story continues. And if it brings a couple of quarters of here and there underperformance, we are okay with it. But yeah, it's people who look to do tactical allocations. I think it can be done because I think 24 can be a decent year for the large caps.
Okay, Vikas, great to have you on the show. Thanks as always for taking the time out and speaking with us.
Thank you. Lovely talking to you, and thanks for having me.
Okay, that's the word coming in from Vikas Khemani. Infosys, can't take your eyes off from this one. Almost a 6% notch up is what you're seeing on Infi right now. Not the Nifty, but Infosys, 6.25% higher. That's the kind of move that the stock has had. So it's built onto that opening gap that it saw earlier this morning. Remember, the stock jumped up over 4% to start off trade with, and from there also you've seen a steady rise up. 6.25% higher for Infi. There's of course Techem also, which is higher by 3.5%. Wipro up 3.5%. LTIM up nearly 3%. And TCS is a steady ship at a 2.5% move coming in right now. There's Coforge up 4%. Infosys up 4%. And, we always talk about whether leadership within IT has changed. Last year, it was about individual niche stories like KPIT Technologies or a persistent systems. But no, today's move in the market really tells you that leadership remains with the big guns. Look at what TCS and Infosys are doing to the rest of the pack and how they're rubbing off onto the rest of the, IT basket as well. Oracle Finance, Techem, they're all holding up very, very smartly in trade. So is actually outside the sector, of course, Tata Consumer, 2.5% higher for that one. L&T as well has been not a big mover, but about a 0.4% move nonetheless coming in there. But not a material move once again from HDFC Bank. And today Reliance has started off actually in the red. So today it's really single-handedly IT, which is what is reflecting on the index. And that move of 93 points that you're seeing on the futures is all thanks to the way the IT sector has been moving. But the one stock, Polycab, let's see where that stock is right now in trade. That's seen a recovery of about 3.5%. But, it still really remains a very murky story because the IT department woes clearly continue to at least weigh in terms of discussion on Polycab. Axis Capital this morning has gone ahead and cut the price target as well, and the stock citing lower margins. They've also lowered their EPS estimates as well. While, of course, Polycab has maintained that the IT department searches are not on their company. It's not them who's got any notification from the government. So let's try and put this puzzle back together. Lisa joins in with updates. Lisa?
Right, so Axis Capital is the only brokerage note that has come up on Polycab, and maintaining an ad on Polycab, they have reduced the target price to 4,300 from 5,809 earlier. Now they have cut the target price. This is to factor in the uncertainties owing to the IT tax rate, and also they have cut the estimates by around 2 to 4%. for FY24, and this is owing to the disruptions in owing to the IT rate. Now they believe that the a multiple D rating is possible, and this is till the challenges are proved otherwise. And for now, they do not have sufficient information to decide if the tax evasion actually occurred and what is the time for final judgment if Polycab decides to contest the charges, and also the scale of impact if the tax charges are proved. Now, Polycab, they have released a statement saying that they have not received any demand notice from or official letter from the IT department as yet, and they have denied any tax evasion and intends to appeal against the same if the charges are levied. But for now, the damage is done. In the last 3 days, we have seen that Polycab's market cap that have eroded by around 20,000 crore, and this has rubbed off on the other players as well, other wire cables as well, KEI Industries as well as RR Cable, which has seen a fall in the last 3 days owing to this, and then the valuations that also has come down from their levels. Polycab, which had hit all-time record high in December, that they have been trending at 45 times. Now it is at around 33 times. So yes, Polycab is in focus on the back of a note coming in from Axis Cap.
Thanks very much for giving that update on what's been happening with Polycab. Let's connect with Sriram Subramaniam, who's the founder and MD at InGovern, who's joining in on the show. Thanks so much for taking time out. Just wanted to talk a little bit about what's been happening with Polycab, because clearly the stock markets have been giving the stock quite a punishment, and perhaps rightly so. If we're looking at the procedure that's been followed by the IT department of not sending a notice and asking for clarifications first from the company coming out, just wanted to ask, the procedure that's taken place, is that as per the norm?
Good morning. I would think not. At the end of the day, the income tax department, by putting out a press release on 9th, that too late in the evening, saying that the company, there is a wires and cables company on which there is unaccounted cash that they have discovered, etc., is doing a disservice to any company for that matter. And ideally, the department should first have sent the demand notice and given the opportunity to the company, and then put out the press release, if anything. So the company has admitted that in December, late December 22nd to 25th, there were raids on its premises across India, there were raids on its dealer network, etc. But the fact of the matter is the demand itself is not yet clear to anybody for that matter. And the IT department, by putting out this press release, is actually doing a disservice to all taxpayers.
Right, obviously there's a bit of a confusion on that front as well. But you know what, according to the income tax department, that's happening, sir, is that the department has also said that they have the power to actually go and reconduct assessments for the past year. So is there a possibility of more such cases that could be coming up? Right now, obviously, we didn't have the exact name coming in, but inferred is that Polycab, that did take the brunt coming in as well, and other wire cables companies already saw the brunt. So is there a possibility that we could see this happening to other companies as well then?
Yeah, I would think so. Obviously, the income tax keeps sending out notices to all companies, be it listed companies. But what is surprising here is the scale of the unaccounted cash that is about 1,000 plus crores. The scale is very high, and that is the reason. Otherwise, the income tax department is always sending out notices to companies at large. So to answer your question, yes, obviously companies will expect to get demand notices left, right and center.
I'm going to just read out what Polycab actually officially said. They said that they reiterate that the company has not received any written communication from the income tax department on the outcome of the search. They're saying that no material adverse impact on the financial position of the company, and that they maintain that. But Mr. Subramaniam, for now, the shortfall, charges, they're all very uncertain. It's pretty grey. What is the maximum scale of impact if charges are proven? Penalty in such cases, I mean, it usually ranges from, I think, 50% for misreporting to about 200% for underreporting. What could be the maximum damage that could come in if it is Polycab or any other company within the sector?
Yeah, as you rightly said, obviously there would be a tax demand on the unaccounted cash. which is at the marginal rate 25 plus this one. Plus, obviously, the penalty, as you said, 200% up to 200%. So it could anywhere be 50% of the unaccounted income, so to say. So if it's 1,000 crores, the total tax demand could be 500 crores, which is a huge number for a single company to bear. And obviously that they will contest it in the income tax appellate tribunal, etc., etc.
As you have said, they have completely denied the claims as per their latest communication. What would be the appropriate course of action apart from what you have flagged off?
No, I would think if obviously they are very, very clear that they are not this one, they would have even yesterday said that we have nothing to hide. But that is not what they have said. They have said they have not received a notice. So they are not denying that there was a raid. There was definitely a raid. They are not saying that we have nothing to hide kind of a thing. They are just saying that they have not received a notice, which could be true. And so from that perspective, the income tax department may not have sent the notice yet, but has put out a press release, which is, I would think, a travesty of justice from that perspective, from procedural perspective.
Right. For this, then what would be the time period for Polycab to actually contest these charges? Any time period limit that they do have to follow?
No, I think once the company gets a notice, it then can appeal immediately. But the assessment and everything takes a longish period of time. So there is no specific time horizon. The income tax authorities can go on in the past over a multiple number of years and actually figure out what was the total evasion, if any. And so there is no specific time period that the department also works with. But of course, the company would try to resolve it at the earliest for its own benefit.
Okay. Great to then have you on the show, Sriram. Thank you so much for giving us that perspective. All these news flows bring about a lot of panic in the market, and it's, important to try and understand what could be the damage, what has happened so far, and what can be done. Thank you so much once again. Okay, let's move on and let's address what's happening in Tata Consumer. And according to an Economic Times report this morning, Tata Consumer is all set to acquire a controlling stake in Capital Foods and Organic India. ET Now, remember, reported about this story last year on December 18th, that a deal to this extent was brewing for the Ching's secret maker. Cheryl, my colleague, is here, who broke the story back in December with more details. Cheryl?
Hi, Aisha. Yes, rightly put it. December 18th is when we had actually reported that Tata Consumer was close to buying the controlling stake in Capital Foods, which is the parent company of Ching's Secret as well as Smith & Jones Sauces. And today you have Economic Times also reporting similar developments coming in where they will, Tata Consumer will look to buy the controlling stake in Capital Foods, and not just Capital Foods, also Fab India backed Organic India. Remember, Organic India is a maker of the organic teas as well as health products for this Fab India backed company. So it's going to buy the controlling stake in both of these entities. As per sources to Economic Times, the 75% stake that they are looking to buy in Capital Foods will be valued around 5,100 odd crore rupees, while when it comes to the controlling stake in Organic Foods will be valued at around 1,800 crore rupees. Remember that you had back in 2022 when the three founding members of Capital Foods actually put the company up on sale, and Capital Foods, remember, is owned by the founder and chairman Ajay Gupta. You have Invest Group as well as General Atlantic, and Invest Group and General Atlantic will be offloading their stake. That's the stake sale that will happen, and that's the controlling stake that Tata Consumer will take over. Remember that the product portfolio for all of these three companies are pretty diverse. So if you look at Tata Consumer, it has the tea business, it has the salt business, you have the Starbucks JV as well, and Himalayan products as well, Himalayan water that is. While on the other end, for Capital Foods, it deals with noodles, soups, condiments as well as Ching's Secret. While if you talk about Organic India, it has teas, herbal supplements as well as personal care. So the fact being that Tata Consumer is aiming to be a wholesome, a complete FMCG company, and these acquisitions will actually augur well for Tata Consumer. And not just this is the not just this. You also have Nuvama Alternatives that's come out with this report today, where they are saying that Tata Consumer will likely see inflow of about around $30 million today. And this will be primarily in the last 30 minutes of the trading session. And this flow will actually be owing to the merger impact with Tata Coffee. So a lot of factors actually working at play when it comes to Tata Consumer today. As you can see, the stock is also soaring in trade. It's actually gaining as much as 2.5%, 2.6% as we speak right now, Aisha.
Thank you so much for that, Cheryl. Tata Consumer surely is buzzing away in trade. And, just a bit more details. Tata Consumers has always been quite focused on that inorganic growth, like they want to become the complete player in FMCG, and they have been focusing a lot on Soulful that they had acquired, a successful acquisition they made there, and that added in terms of synergies for the company as well. So these two acquisitions also, according to Nuvama research, it suggests that they could potentially add as much as 10% to the top line and almost 13 to 14% to the EBITDA. So Tata Consumers has been a play. They have been acquiring a lot of smaller companies, adding and expanding their portfolio, and that is something that has obviously helped Tata Consumer in terms of their growth and appeal in terms of their portfolio. And healthy alternatives is what they've been focusing on. So it's a very interesting play that's happened over there. But other than Tata Consumers, we have the Nifty companies, two Nifty companies, that's TCS and Infosys. These IT companies both are on fire after they have reported their Q3 numbers. What is the management commentary sounding more optimistic? What more details are coming in? Anisha is joining in with us to give us the detail and roundup for TCS as well as Infosys. Anisha?
Oh, well, yes, it's the biggest single session gain that we have seen on Infosys in the last 3 years. Last time it hit that mark in terms of the gains of over 6% was back in July 2020. Today it's almost 7% higher. Take a look at TCS, that's up around 4%. And the reason these stocks are surging is that there has been no incremental bad news at least. And if at all, there's a positive read-through coming in, both in terms of the numbers plus the management commentary, and hence the stocks are reacting positively. Let me start with TCS first, because there the management sounded a lot more optimistic. They said FY25 is going to be better than FY24 with a very high level of conviction, and they also called out how BFSI is likely to come back to growth in Q4 itself. BFSI of course forms a large part of all these IT companies' revenue, anywhere between 30 to 35%, and that turning around is an important factor for the entire sector. Separately, even if you see it in terms of earnings, the margin resilience that TCS reported this time around has been light across the board. 25% was the target exit rate that they had for themselves at the end of FY24. They've managed to achieve it a quarter ahead itself, and that has come in at a time when there was a seasonally weak quarter. There was a BSNL deal impact coming in through, plus a lot of headwinds in terms of the furloughs, etc., that we usually talk about. So all of that has been factored in, and the productivity gains is something that the street likes. And not just that, they're not calling out that this is the maximum that they can do in terms of margins. There's a runway of growth available for the margins to expand from here on as well, and that's been particularly liked by the street. Shifting focus to Infosys, yes, of course, there was a revenue decline of around 1% on constant currency basis, but this is much lower than what street was anticipating. There were people on the street expecting a decline of as much as 2%, so a lot better than that. And even if you look at the deal wins, they were very solid at $3.2 billion. Street was expecting that it's going to be between $2 to $2.5 billion. 3.2% is something that is definitely, which is very good. Of course, it's come off the $7-8 billion that we had seen last quarter, but that was an exceptional time. The other thing is that margins have been very steady for them, 20.5%, and this is despite factoring in the wage hike impact that happened this time around. Yes, the headcount for both the companies have come off, and the indication suggests that's going to be the trend for the next few quarters as well. Attrition too has been coming down, and that's been supportive of the cost. But I think the clear, commentary coming in about FY25 being better, certain verticals like manufacturing, energy, life sciences seeing a lot more traction, and AI turning into an actual revenue potential is something which has been liked by the street, and hence those surges on the stock prices. Valuations are not specifically cheap. Infosys is 23 times forward earnings, TCS is 27 times, with the kind of resilience TCS has shown tells you that premium is likely to continue. In fact, listen in to what management of both the companies had to tell ET Now.
We see the outlook in essence quite similar, but the guidance is tightened. That's how we're seeing it, based on what we've seen in the first 3 quarters, where our growth has been 1.8% in constant currency terms over the previous year's 3 quarters. And that's really all we've done with the guidance. At this stage, we have not seen any different behavior from clients. Typically, as you know well, Q3 is a quarter with large furloughs and other end-of-year holidays, and that we've seen continue. We've not seen either an increase or either a decrease, so the same sort of a view.
We look at our order book. Okay, the order book has been very positive. So it gives us a confidence the clients are still thinking long term, still thinking strategic programs. They are trying to improve more, get more digital transformation, and there is more technologies like generative AI coming into play. They would want to get more benefits, products, new services coming out of all these things. So we are quite optimistic in the medium to long term. So that's a major difference for us compared to how 2023 panned out.
Okay, so medium term is optimistic.
Medium to long term. Yeah.
Fair, medium to long term is optimistic. But let me take a leaf out of that and discuss client budgets. Because the last time we spoke, you said that you'll be better placed in January to talk a bit more about it. Talk to us about how things look right now.
We are not in a position to call whether the budgets have improved. But again, we kept mentioning yesterday, we also moved away from that, reading too much into the annual budgets.
Okay.
And our clients are also, because everyone wants to be agile. The decisions are taken almost on a quarterly basis based on the situation. So we keep very close watch and work closely with our clients and make our decision.
So NGS, let me bring you into the conversation, and I want to talk about the BFSI vertical specifically. This time around as well, there was another decline. In fact, it was more pronounced this time. Are you confident to call it the bottom, or do you think it will get worse before it gets better? Will Q4 see a growth in BFSI or not?
There are a couple of large engagements in BFSI. We completed during the quarter, and that has resulted in some amount of weakness. And seasonally, you know, almost in every market, BFSI segment has furlough impact. So that has really, you know, whatever the -3% that we talk about this quarter.
All right, and both those stocks holding out well in today's trading session. That's IT for you. But let's shift gears then, and Harold van der Linde, who's head of Asia Equity Strategy at HSBC, joins in to put the spotlight on the big India call from HSBC and how the macros and micros shape up. Good to have you on board. Thanks much for taking time out and joining in. So just to sum it up, are you saying that despite a few short-term concerns that the macro story for India is looking resilient versus the other emerging markets?
Absolutely. I think resilient is even an understatement. There's a couple of things going well for India. You got, well, at the moment, you actually got some decent export numbers. So some of these IT companies that are coming through. I'm a little bit worried as we go deeper into 2024 that maybe that weakens a little bit. But if you look at the domestic side, investments are good. Consumer is doing well. A lot of the drivers have to do, for example, with formal retail, gaining market share over informal retail, reshuffling of supply chains across the region. Those are not things that come in January or go in February. Those are things that play out over multiple years. So we feel that actually the earnings growth forecasts for India over the next 3 years should actually look pretty good. You're talking about maybe on average 15 to 18% or so. That sounds not bad. Last year we had 26%. This year consensus is looking for something like 18%. So yeah, we can make that assumption that earnings growth is going to hold up reasonably well, and that's a real good thing for Indian equities. So we consider it a market where you want to buy on dips and hold on to it, and that's very different than some of the other markets in the region, which you're showing here at the moment.
Yeah, sure. We're waiting for those dips, though. But nonetheless, yeah. Where is the money going to find its way, though, Harold? Because, you know, the consensus call seems to be it's got to be financials. They're the, deepest sector and FI money because it's going to come in hordes and quantums. That's going to move in there. But you know what's interestingly happening here in India is that more than the large caps, it's the broader markets outside the Nifty 50 names where all the action seems to be going on. Do you think there could be a tactical shift this time around? Where could FIs park their money?
Well, that's a very interesting topic. And here in Hong Kong, my colleague Prerna Garg sits next to me, and every day she's looking at all these small caps that are just soaring in the Indian market. My feeling is that there's going to be a rotation from these small and mid caps into the large caps. So you mentioned the banks. I think they look pretty good. The problem I have with small and mid caps is that not only have they performed a lot, but the liquidity can be very volatile in the sense that if markets do turn for some reason that we might not easily identify at the moment, that the liquidity can dry up in those places as well. Another thing that maybe works in favor of large caps is that what we see in India is that a lot of people have been basically buying their own stocks in the market, but increasingly they're putting money into mutual funds. And these mutual funds tend to be more focused on some of the large caps. So I wonder if we're going to see that shift from small and mid caps, strong performance into large caps. Now that's something that we said 2 weeks ago, but so far some of these small caps are still doing really, really, really well.
You saying really 3 times really spells it out. But on the large cap specifically, because, you know, of the quantum of FI money which is going to come in, it's typically going to come in into large caps. Where within large caps do you think it's going to flow in? We discussed financials, but outside of that, you know, for instance, IT seems to be making a comeback. We've just heard from the 2 IT bellwethers, Infosys as well as TCS, and the numbers don't look bad, not as the commentary.
No, that's right. So IT, what you just mentioned, right? Just showing up here, Infosys is performing very well today. So the results were not as bad as what the market anticipated. And overnight, we've seen that these ADRs have actually held up pretty well. And I think this is why you got this strong performance in the Indian market this morning. But that's not where I would really look for in the Indian market. If I look at where the growth drivers are, they're more domestic. I think the exporters face increasingly, as we go deeper into 2024, problems that maybe the US economy and Europe, as well as China actually, are starting to slow. So while at the moment the numbers are still pretty good, I wonder if this is still the case in 9 months' time. While on the domestic side, I think the growth is more visible and it's going to hold up better as well. So I prefer domestic-oriented companies. Now, banks are a great example there. One issue with banks, though, is that we see that the loan deposit ratios in India are already quite high. That means that if banks want to extend more loans, they need to get more deposits in. You either raise interest rates to do so, that's not good for your margins, or you just don't do that and say, I'm going to cut down on my loan growth. And suspect something like that will take place in India. So the cost of growth and the difficulties of credit growth will come through as well. So very companies that need a lot of cash, that might be a bit of an issue. But I'm thinking about cash-rich, domestic-oriented companies with strong cash flows. I think about the retailers, some of the jewelry retailers, amongst others, some of the consumer names, staples as well. Consumer discretionary has outperformed staples. So I would look in the staple space for relative value in India as well. So yeah, banks, consumer staples, retailers, that's where I would be looking at.
Right, Harold, this is Vinny joining in the conversation as well. Good morning. Let's talk about FII flows, right? They were a bit subdued, but now finally seems like since the month of December, like they're coming back. Seems like it's going to be there for some period of time. Is that the view that you have? Do you think they'll be persisting in 2024, FII flows to India?
Yeah, I think they might well persist. So there's 2 things going on. First of all, you have money that comes into the region. We see global bond yields coming down. The dollar has weakened a little bit. I don't think that's going to be too dramatic, honestly. But that has meant that people have taken money out of deposits, out of the US into the rest of the world, and Asia's benefited for that. And that explains to a large extent, I think, why money has flown into India. But within Asia, there's a second dynamic. In India, very often people are worried that if China starts to recover, that money is taken out of India and goes into China, that might well be the case. And we shouldn't rule that out. But I think a lot of investors at the moment are fairly overweight on Korea, Japan, and Taiwan. In particular, I think Japan holdings are pretty high, pretty hefty. And in Korea, actually, as well. And I think this is where the money is coming from. If you look at the relative performance year to date, Korea has actually not performed so well. My suspicion is that within Asia, you have a bit of reallocation of money from Korea, maybe a bit from Japan eventually as well, not at the moment, that could go into China, but it could also go into India, actually. So I'm not too worried about foreign flows for India at the moment yet. What foreigners do have a bit of a problem with is simply valuations. India is quite expensive. So we need to see that growth coming through because that supports these valuations. If that is not the case, we see disappointment starting to come through, earnings downgrades, then that would be a real risk for Indian equities.
But tell me, Harold, I mean, are China, Hong Kong right now only good contra bets because they're coming out of such oversold zones? Or are there pointers and, indicators on ground which tell you that there could be a meaningful recovery actually taking place?
There are very early signs that maybe things are starting to improve. On the property side, there are some green shoots. It's maybe a little bit of an overstatement, but there are some signs that things are at least not deteriorating as much as they were 2, 3, 4 months ago or so. As you say so, valuations in China are really low. If you look at trading patterns in China, typically, if you go another couple of percentage lower from here, you're reaching really low multiples beyond which China hardly ever trades. So that is supportive as well. But what is interesting as well is that money that has come into the region because US bond yields have declined, that I mentioned earlier, that went amongst others to India, that hasn't really gone to China. I think people are worried about some of the policy risk in China. The announcements have come through that have really had a big impact on the dynamics in certain industries, gaming most prominently over the last couple of weeks. That has created a lot of volatility in some of these sectors. And people are worried, like, will this happen again? Do I invest in a sector that suddenly overnight regulations change and these companies' valuations evaporate in front of my eyes? So people are really worried about these sort of issues as well. And that is more structural in nature, and that will probably inhibit some of the flows that might flow normally into China. And that's good for India, Japan, Korea, because that's where people then have to put their money in the region.
All right, good to have you on board, Harold. Thanks so much for giving us deeper insights into the latest note and, of course, the India story and where things stand. Just a quick check-in as to what the market is up to. I'm going to ignore IT for the moment and check in on the rest of the market. We're up 0.5% at 21,757 levels. The broader end of the market is also looking smart with the small cap index ecking out a gain of about 0.7%. Yes, of course, there's a lot of IT, but other than that, Minda Corp is in the green. You've also got Polycab, which has bounced back after days of carnage. Something like a Motilal Oswal, KSB Pumps, as well as JM Financial, but honestly really struggling to find other names other than large and mid-cap IT, which is dominating the winners list. But that aside, shifting focus, it's D-Day for the Trans-Harbour Link in Mumbai. It's the longest sea bridge in the country with almost 22 kilometers at a stretch. The Atal Setu Bridge will be inaugurated by the Prime Minister Narendra Modi, and this will cover a journey of just 2 hours in just 20 minutes now. Let's go across to my colleague Aishwarya Patil, who joins in with the latest. Aishwarya?
Well, Avan, the VJ Tushar and I, we've got our passes ready. We're right here at the entrance of the MTHL bridge. As you can see behind me, that's the Eastern Express Freeway that joins with the MTHL bridge. There are multiple exits here. On the top, as you can see, preparations have been in full swing for the Prime Minister's welcome and for the inauguration. There's tight security. We've seen the catering arrive. We've seen the flowers arrive. As we speak. Now, at this point, the Prime Minister is obviously in Nashik. By 3 p.m. this afternoon, we will be expecting Prime Minister Narendra Modi to come to the MTHL bridge for the inauguration. As far as you rightly mentioned, the MTHL bridge is concerned, it's 22 kilometers long, and what's most important is that it connects the mainland of Mumbai to Navi Mumbai and will ferry you in just 22 minutes. It's India's longest sea bridge and the 12th longest sea bridge in the world. As far as Prime Minister's visit is concerned, after this particular inauguration, he will be heading to Navi Mumbai International Airport to take stock of what the development looks like so far. He will also have a couple of road shows. So that's about his schedule as far as the MTHL bridge is concerned. Once this is opened for four-wheelers, the toll charges have now been revised. It will be 200 rupees for a single trip. As far as the other larger vehicles are concerned, on the other side of Navi Mumbai, you have ONGC, you also have couple of other port trusts as well. There's Nava Sheva. So you'll see a lot of heavy vehicles moving through this bridge. But the toll for the bigger, larger vehicles have not yet been declared. It will be decided very soon by the Maharashtra cabinet. So this is what it looks like so far. The Prime Minister is going to arrive very soon, and we'll keep you posted with the action on ground.
Okay, Aishwarya, thank you so much for that update coming in, and we'll be waiting for the inauguration and more updates there. But with that, let's just slip into a very short break. We'll be back with more updates after the break.
Powered by.
Welcome back, and you're watching the market on ET now. Let's talk about power sector. That has been in focus when we've seen all these power stocks actually buzzing away in trade, almost near the 10-year high. Valuations have peaked as well. But what's the story now playing out for the power sector? Nikhil Nigania is joining in with us, director and senior analyst at Bernstein. Nikhil, very good morning. Thank you so much for joining in with us. And Nikhil, I want to talk by starting about the past up cycles that we've seen versus now. When you differentiate in the past upcycle, obviously there was problem about shortages across different time periods, not a specific time period. Other than that, obviously in terms of investments that were made, there were not too much investments made in the power sector in the past upcycle. Now it's a different story this time. So when we have to pick out the winners in the power sector, what is going to be a different story this time? Where should one be looking in the power sector?
Thank you for having me on the show. So if we compare the last power cycle, which went up right till 2012, versus the current cycle, which started, I would say, a year and a half back, the primary difference, as you said, is last time there was consistent power shortage throughout the day because we did not have enough private sector participation. It was largely state-owned enterprise who was setting up power plants back then. And this time around, while the private sector participation was strong earlier, now we have a unique situation where due to addition of only solar capacity, largely solar capacity, we have shortage in the non-solar hours of the day. So it's very specific to a time of day power shortage that we have, which is happening. And secondly, at the same time, we are doing energy transition. So we are doing energy transition and also solving for non-solar hour shortage, which is leading to a power cycle this time. In terms of the winners of this last cycle versus this cycle, so the last power cycle, the biggest beneficiary were the early entrants. And that too early entrants who had merchant power capacity. For example, Jindal Steel and Power last time had a merchant plant which came very early in the cycle, 2007-8, and they were able to make the largest returns given they were early and there was a massive shortage and they had power prices as high as 7-8 rupees on the exchange back then. Then we went into a surplus phase for almost 5-6 years, 2015 to 20, and now we are again into shortages. So this time round as well, typically in power, the entities with merchant power capacity stand to make more gains than others. So that's one category of winners. The second category of winners this time would be players who are still open to investing in thermal capacities, because thermal is very important to solve the non-solar problem of India, where our company in coverage NTPC comes in, which is our top pick in the sector, which is going to add, we think, both thermal, renewable, and even participate in hydrogen.
Nikhil, but the point is that power stocks, and I'm purely talking, in terms of shareholders right now, they've made some phenomenal returns, right? And yet you always question whether the price that you're paying right now, the valuation justifies the growth that these companies are going to post. Do you think that, while you can't really point a fault here, the stocks have run up ahead of the fundamentals or not quite?
No, fair question. So see, sector thematically, we think the sector should be positive for a medium term. The power shortages should continue medium term. But valuations, yes, I think they have run up quite a bit. But there are, so one, I think investor needs to be selective right now. One can't do a broader play. And there are some names like NTPC which have still not reached the last cycle peak valuations yet. We don't think it'll get there. Plus, we don't think investors should from here expect the kind of returns they saw last year. It'll be a more gradual return and a slightly more longer story from here.
Nikhil, hi, morning. I wanted to understand your outlook in particular then as to how we're looking at a renewable surge then in the year ahead. Do you think that as we're seeing solar costs plummet, what is the outlook then when it comes to renewable projects that are in the pipeline that have been tendered so far and what the year ahead spells for it?
Sure. So renewable sector, see, it's largely impacted by three things. One is the module prices, which are at it's the lowest point in history. Module prices have fallen to 12-13 cents from as high as 25-26 cents during the COVID years. And second is interest rates, which are expected to come down. And the third is the market size. So it's been a very competitive market for renewables historically. But now the market size has expanded and the competition is relatively lesser. So all these three aspects points to a very positive year for renewables that ways. And for developers especially, it looks like a positive year. For the manufacturing companies though, the companies manufacturing solar panels, we are still not very certain. We think there's a supply glut coming. So we don't think that's the best business to be in. But solar developers, it looks like the perfect setup. Falling interest rates, falling module cost, increasing market size. So we should see large capacity additions also happen this year in renewables. All of that which got paused for a couple of years due to high module cost and better returns for the sector as well for renewable companies. Is literally the perfect setup, I think, which could have happened for them. Yeah.
Surely a year for renewables, but when you talk about the sector as a whole, do you think that this is just the beginning of the upcycle? Or, because like I was reading the note that came in also that, you're still expecting that power shortage to continue this time in 2024 as well. So could we say that this is just the starting of the upcycle, or maybe now it's time that we would see a pause here?
Exactly. So from a sector perspective, see, the thing that happens in the power sector is once a power shortage starts, for it to go away is not easy. Because all of the solutions to the non-solar power shortage are long gestation projects. To add a new thermal plant, it takes 4 to 5 years. To add a hydro plant, it takes 10 years. Similarly for nuclear as well. And even for a pump storage plant, which is being talked about a lot, it takes 6 years. So once a shortage starts, which it has started since last year, it's not easy to take it away. So unless power demand disappoints, which also doesn't look like it'll disappoint this year, given the average temperature globally is expected to be high again this year. So the cycle from a sector perspective definitely should last a few years. We don't see it going away. But valuations, as we said, more gradual up from here rather than the kind of return we saw last year.
Because since you just briefly touched upon pump storage, the last time we were chatting, I recall you calling it the AI of the sector. Does it continue to hold that status according to you?
I think the market does associate it like that almost. So any company which is coming and signing an MOU on pump storage, the stocks are reacting immediately. See, as a solution, we think it's a brilliant solution. It is much cheaper than batteries. The life of a pump storage plant could be up to 100 years versus a battery which does like 5 years and then 5-10 years and then we have to replace it. So from a solution standpoint, it's excellent. But we have to remember that the companies which are signing MOUs, the plants will come after 5-6 years. The plants, you won't see the earning impact right away. So good solution for the sector, but earnings impact still quite a way. And there also, I think the early entrants would be winners. So there's a private company called Greenco, which saw this problem coming back in 2018. And since then, they have been in the process of setting them up. So companies like those stand to gain the most in such a situation.
What is the right way, given the valuations that most of these stocks are currently sitting at, to get a piece of the power play? Because, all companies have pumped up their investment across the entire space right now. Could we look at, say, some of the capital goods / industrial plays? Is that the new way to approach power, maybe?
So you're right. So there are three ways to approach it. One is the capital good names. Second is the power financier, and third are the utility companies. So the nearest term gainers are usually capital good companies. So for example, transformers is currently become a bit of a bottleneck for the industry, is what I'm hearing from developers. Access to transformers is taking longer. So hence equipment demand and the capex cycle in power should definitely drive up the capital good names. But we don't cover them, but the valuations definitely prima facie look higher. Second are the financiers. Financiers again have rallied as well. But there we see more visibility on loan book growth. We see very low risk of NPAs happening, given renewables are a much safer investment that way from a developer standpoint than a thermal plant, which is much riskier, takes longer, has more moving parts. So finances, I think, are in a good setup as well. And third are utilities, which are the likes of NTPC, which we cover, and NTPC we like. Between these three, while all three will gain from a valuation standpoint, and we prefer the NTPCs of the world and possibly power financiers over the capital goods, largely because of the valuations. Yeah.
Just one last thing I want to know is in terms of merchant powers, is it the best play in the upcycle? Is merchant power the best to own, in terms of the better cash flow that they have? So is that a best play in this upcycle then?
Almost all power shortage cycles, ideally the guy who makes the most money is the person with a merchant power plant. The same thing happened with Jindal Steel and Power last time, which we don't cover. But this time around, there are a few entities who have merchant power plants. JSPL, I think, has moved the merchant plants to the promoter from the listed entity. But entities who have merchant plants, they can make the benefit of the high power price on the power exchange. So average price on the power exchange right now are 5 rupees, but they can go as high to 8 or 10 rupees in the non-solar hours, or especially in the summer months. So the plants with long-term PPAs, they can't benefit from that. But entities who have merchant capacity, untied capacity, they are the ones who can benefit from the high power prices in the short-term market.
Okay, Nikhil, thank you so much for joining in with us this morning on ET Now, giving us a roundup in terms of the power sector as well. It's always a pleasure having you on the show. On that note, let's just slip into a very short break. We'll be back with more after the break.
Sir,